Good evening. So tonight this is week 12, we're going to be talking about stocks and bonds. So the following week we're going to be talking about mutual funds. Mutual funds are probably a better investment in terms of for most people, based on diversification and all the other reasons that we'll go into next week. But anyway, the underlying elements of a mutual fund is typically stocks, although there can be those same types of funds that are in bonds as well. So again, the applicability of or desirability of most of you investing in individual stocks or individual bonds, probably not something most people would recommend unless you've got a fair amount of experience in it, or if you're doing it just to sort of experiment and get some experience and not put in a great deal of wealth into it. But anyway, the underlying elements, though, of most mutual funds and equity funds are going to be made of stock. So it's important that you know a little bit about it. These are going to be the objectives and the essential elements, how stocks are bought and sold. You can do that today. There's nothing to prevent that. Although stocks are becoming more of an institutional investment, meaning that pension funds and big players are the ones doing a lot of the investing, and individuals, frankly, a lot of individuals kind of got burned because there's information that's not necessarily available. Should be, but a lot of times the market will move and an individual will get caught on the wrong side of it, whereas the institutions a lot of time, get some sort of warning. So it's kind of a dicey thing. Anyway, like I say, most folks would prefer to go mutual funds, which is a collection of stocks, maybe in a sector or something. But we'll talk more about that as we go. Okay, so if you are going to invest in individual stocks, stocks are units of a company. Companies use this; they sell shares in their company to generate capital to expand or build their company. So since you're going to be investing in a company, you need to know a little bit about that company to make an advised decision. So most people refer to that as due diligence. You do your due diligence by studying up on the particular stock and the rest of it. The caveat, though, that I'd make, especially in the era we live in now, is that the health of the company doesn't necessarily. There's a lot more to it than that. And again, I hate to keep reiterating on it, but the Fed plays a big role in the market right now. The the book, they make a very big deal out of preferred stock. There's common and preferred stock. The nuances in between common and preferred, I mean, there are differences, but the deal is, for most people who would be, in the average demographic taking this class, you'd be interested in growth stocks. Um, Okay, so let me start over. I'm getting kind of ahead of myself. You've got common and preferred stock. They're both stock in the company, although they're treated differently when it comes to paying dividends. The preferred stocks, um, they have the first right to the dividends when the company's going to pay a dividend. Companies don't always pay dividends, but when they do, if there's not enough basically to go around, or they make a decision only to pay dividends to certain shareholders, well, the preferred stock shareholders are going to get the dividend. But the thing is, for most of the companies, at least the companies I've always been interested in, and I'm not even to that point in my life, and I'm probably a lot older than most of you, I'm still interested in growth companies. I'm not interested in the big mega companies that are paying dividends, the big established companies, utilities and big companies like GE and GM and some of these. Frankly, I think they're kind of dinosaurs. They would pay dividends. Now, if you're if that's your model, and you've studied up, and you decide you're going to be going after the large blue chip kind of companies that offer a dividend, and you want an income stream, um, then preferred stocks are better in that regard. But for me, I've always been after high growth companies, and growth companies, uh, they don't pay dividends generally. They're growing. They reinvest. So when a company makes profits, they can give those to the shareholders in terms of a dividend, um, or they can reinvest in the company. And there's different ways you're going to make money on stock. One is by an annual or a semi-annual dividend that's paid, or the other one is by the stock price appreciating. Buy low, sell high, and so that's what you're doing when you're using a growth stock. So again, the authors, they talk a lot about common and preferred stock, and it begs the question, well, golly, why wouldn't you always get the preferred stock? Well, because the companies that are paying dividends, that would have preferred stock, many times are not the kind of companies you'd be looking for. And it is true, the companies that don't pay dividends, and the growth companies, yeah, they may be a bit more aggressive, and they may be a bit riskier, but the yield's going to be, uh, the return should be higher. And if you're concerned about risk, um, you're probably better off going with those growth companies, but purchasing them in a mutual fund, which would be a collection of, say, 20, 100 companies, whatever the nature of the fund is, and that's how your um, risk is mitigated, because the odds of all of those companies in a certain sector going down at once, that's pretty rare. Um, uh, High growth company, for it to have a bad period, unfortunately, that's not that rare. So again, the difference between common and preferred stocks, it just has to do with the difference in the way dividends are are distributed, and the preferred stock get preference when it comes to those dividends. So that's it. We'll talk a little bit more about that, because they really tend to hammer preferred versus common stock. For me, I'm pretty much exclusively in common stock. And when people say, "Oh, I've got stock in whatever company," most people are talking about just common stock. So, like I said, the reason why they sell stock is to you know raise money, startup costs, expansion, all that. They don't have to repay it, but you do own part of that company, and they are liquid. You can sell that stock to another investor. There's a primary and a secondary market. Primary would be you be buying that stock directly from the company on that initial purchase. Secondary market is you'd be buying through one of the exchanges, where essentially you're buying stock that's already out there in the market. Um, Dividends are not mandatory. Most corporations distribute 30 to 70. Yeah, again, this has to do with big established blue chip type companies. In return for investing, the company's stockholders have voting rights. Um, you know, there's millions of shares out there, and your 30 shares, you do get a vote, and you will get a proxy in the mail if you own that individual stock. But you know, uh, anyway, it's not quite worth the stamp for me to get involved in that, because my vote is not worth enough. If I had a substantial stake in a company, I'd definitely be interested. But for most of us, the voting rights are not that important. Why investors purchase stock? Okay, so this is how we're talking about the income from dividends. Again, if it's a income type stock, income type investment where it's paying a dividend, the dollar appreciation of stock value. That's where most people get it. And then this third way, that's not really a growth. There's really two ways. because this third way, possible increase in value from stock split. Okay, if let's say a company's stock splits and you get a 2-for-1 split, so it's trading for 30 bucks a share, they split the stock and you get 2 shares, but they're both valued at $15. Did you make any money? No. All it did was split. Now the fact that the company, the corporation, chose to split it probably meant that that stock was appreciating, and it got to a level that they were more comfortable with having, in this case, a $15 stock, and they just decided to split. But the split itself did not generate wealth for anybody. All they did was split in half, and it was an absolute, split. So you had one $30 share, now you have two $15 shares. No wealth was created. It may attract some attention, to other investors that this company's doing well. It may do something else, but it doesn't generate wealth. So again, a bit confusing. There's two ways you make money on stock. One is from dividends. Two is from the appreciation of the stock value. Okay, again, this preferred stock, right back at it. Middle investment, what they're saying there, middle investment is because there's, since it's paying a dividend, typically, there's some interest, in terms of an investment. It's not just the appreciation of the stock price, but the preferred stock, since there's a dividend implied here, part of that price of the preferred stock is going to be related to interest rates, which is not what typically happens with common stock. So anyway, investors that need a more predictable source of income will choose preferred rather than common stock. So let's say you are 65, you're going to be retiring, you've had a fair amount of money in common stock. You don't want these fluctuations of the stock market, because the stock market, they say tends to go up about 10% a year as a gross rule of thumb. Well, that's over the long haul. There's many, many times where it drops and then rebounds. The 2007, 2008, the Dow Jones Industrials is now twice what it was back in those days. That doesn't mean that the only way people actually doubled their money were to have sold everything, to have had this vision and known the market was going to collapse, got totally out of the market, and then bought back in at the low point sometime, right around there, 2008-ish, and followed it on up. That's impeccable market timing. But anyway, for most folks, they wrote it down, they wrote it back up, and they're better off than where they were, and maybe that equates to perhaps 10% a year. But if you're getting closer, you're in retirement, and you're starting to draw against that income, being all in equities, all in stocks, individual stocks especially, that don't pay dividends, that is, a dangerous place to be if you're relying on that money for income. If you're passing on to your heirs, then inheritance, well, it's just fine. Let them ride it out. They'll get a large inheritance at some point. The only time you get burned in the stock market is when you sell, when the market is in decline. So as long as you ride it out, you can talk about a paper loss, but that's all it is, a paper loss. You don't make or lose money until you sell the stock. You just see the numbers sort of change up and down. So again, preferred stock, you're the owner of stock, but you have a known rate of return. Shares are safer than common stock because dividends are more secure. If the company goes out of business, you're both done. Preferred stock will have slightly better in terms of creditors. If they go into bankruptcy, you will be ahead of common stock, but only slightly, and all the other creditors will be ahead of you. So common stock, if the company goes bankrupt, common stock will get nothing. Preferred stock will get nothing, but it'll take a little longer before they actually figure out they got nothing. They will be in ahead of them, ahead of the common stock folks, but only slightly. And at the end of the day, it will not likely make a difference. So, cumulative preferred stock, unpaid cash dividends can accumulate and be paid for other common stocks. So there's different types of preferred stocks. You also have the convertible ones. That's where you can trade them out for common stock in the same company. But again, this depends on the price of the common stock, whether or not that is a good deal, whether or not you want to convert it. Depends on the prices per share. So again, these are, evaluating stock issue, classification of stocks. I've already said blue chip stock. Those are the big boys, the large capitalizations. And cyclical, mid caps, defensive, small caps, growth, micro caps, and income, penny stocks. Anyway, actually they've got them in different columns here. Anyway, the first column here, the blue chip stocks, it does equate with large capitalization, but that's just sort of coincidental. Cyclical, defensive, growth, income, and then large, mid, small, micro, and penny stocks. So penny stocks, again, very speculative, kind of like junk bonds. Those are stocks that literally can be valued as into the cents, but usually under $10. Startup companies, micro caps, very small capitalizations as well. But this first row here, the blue chips, those are usually companies that can be listed on the Dow Jones Industrial. So again, there's certain requirements to be listed on the big exchange. They're going to be well-known, large, established companies. Some of these other ones of interest, though, I've already mentioned the growth stocks. Those are, a lot of times, they're going to equate to those small capitalizations because they're growing. They, are still small and still coming along. In income stocks, those would be the ones that are going to be paying dividends, usually larger established companies, and they aren't growing so much. They're able to pay a dividend. I know this all gets pretty confusing, but it is interesting and fun to invest in individual stocks, but obviously you want to start small, or as I said, mutual funds are probably the better way to go to invest in equities. Okay, evaluating stock issues. Again, some of these, Yahoo, I definitely wouldn't recommend it. It may get you off on a tangent, but Standard & Poor's Value Line and Morningstar, especially for mutual funds, those are all excellent sources. You can usually, if you're going to be buying stock, let's say you're signed up with Scottrade or E-Trade or one of the other discount brokerages, they will typically have a research service that will be tied to one of these large stock evaluating companies, and that is probably a good way to get access to do your review and look at charts and look at the underlying financials of a company. But don't get too far distracted by the financials of the company. What you really want to look at is something like, say, a company like Netflix. Their stock is doing pretty well. They are a high growth company. But more importantly, the people who made money on Netflix were people who said, you know what, this could work. You know what I mean? You see a company sort of emerge out of the pack. It's a speculative investment, but if it's something that makes sense to you, that is, a pretty good criteria. Warren Buffett, the Oracle of Omaha, the man's made a lot of money, and one of the criteria he uses for stocks is, and investing in companies, is whether he can, understand that company. Does it make sense that this company is going to do well? Are they making a product that's in demand? Does it appear to be a well-run company? And a lot of times that will be as valuable as any any number of charts and earnings per share and all these other ratios that may just get you bogged down. You need both, but again, make sure it's fundamentally sound company. Okay, stock advisory services. Again, if you are going to invest, you can actually get a broker and get a little bit more personalized service. I don't do that. I've gotten burned in the past. Like I might have mentioned, I ended up buying some stock and I found out that, I don't know whether the guy got a toaster oven or whatever for me buying the stock in the particular company, but it certainly was not unbiased advice. So I, you know, try to do my own research. Um, in doing my own research, I have been a customer of both Scottrade, E-Trade, and a few others, and through their research areas, again, I'm not looking for specific recommendations by that company, but what I'm looking for is access to some of these Standard & Poor's, Value Lines, Morningstar that you can get by being a client for one of those brokerage firms. So again, check into that before you go direct to the site. See if it's not included on one of the investment services that you might have to be doing business with anyway. And that's how you buy stock. You place orders through a brokerage, and typically a discount brokerage, and they are set up for people who also want to do their own research. Financial section of the newspaper. Again, Wall Street Journal's good. I like Barron's as well. But this part, just the basics of what you'd be getting out of the newspaper, you can get that quite easily off of the internet. And for the level of information you're getting, this might be the case where if you just want to look at a stock price, yeah, you can use Yahoo Finance or Google Finance or something. If you know the ticker symbol of a company, you just type it in. And obviously with the internet, you can get the ticker symbol quite easily. But the price, it doesn't give you a whole bunch of information. I like charts. I like to see the trends. So a raw stock quote doesn't do me a whole lot of good. Also, the SEC, Securities Exchange Commission, they put out information, but again, it's as a government website, it's not going to be as useful. They, you can get some information through their site, but the important thing is as a publicly traded company, companies have to disclose information to the SEC. So again, when you're doing your research, you'll see SEC filings. You'll see a lot of the information that in the annual report, there'll be a lot of gloss and a lot of fluff in there, but there'll also be some basic financial details that are required by virtue of the SEC. Numerical measures. Earnings, yeah, again, it depends on the type of company you're looking at. Amazon's earnings, non-existent. Twitter, they haven't had a profit yet. So, again, are you comparing apples to apples here? If you're looking at the big blue chips, if you're looking at getting a dividend, these numbers are critical. If you're looking at growth companies, you'll be looking at other measures. But a couple measures we're looking at here: earnings per share. So again, number of outstanding shares divided, the earnings divided by the outstanding shares, and then the price to earnings ratio, price of stock divided by the earnings per share over the last 12 months. Anyway, again, there's not a lot of interchange between the different companies. It's not it's very hard to compare companies just based upon those two numbers. Again, there they are, the actual math. Other factors that influence the price of a stock. So total return, dividends, and capital gains. Again, most stocks, and maybe I'm a bit atypical here, but I typically do not look for stocks that pay a dividend. I'm more interested in the stock price appreciating. I'm looking for a high growth company, and I'll make my money by selling the stock for the price appreciation. If they were paying me dividends, I would simply just reinvest them because I'm not trying to get income right now. I don't need to be paying the taxes on those items just yet. If you sell stock, the day you sell it, it generates a taxable event. So again, that may influence when you do decide to sell it. But for the next few years, when your prime income making years, you may not want to sell because it's going to put you in a even higher tax situation. The beta, that's the volatility compared to the S&P 500. So, the S&P is assessed to have a beta of 1. So if it's at a 1.5, then it's more volatile. If it's, a 0.8, it's less volatile. Interesting. Again, I I like volatility. So, people make money in markets, down markets, up markets. And again, I would not put money that I need to absolutely live on. I'm fortunate enough to have a pension that would take care of that. So the money that I would put in individual stocks would fit in the category of wants for later in life, not necessarily needs. So again, if you're investing in individual stocks, you need to know what your goals are and what your risk appetite is. Book value per share, that's the assets minus the liability divided by the shares outstanding. So companies can get completely, out of whack. Again, some of these numbers, if you looked at an IPO like Twitter, they would absolutely make no financial sense for anybody to invest in. But again, some people do, and they do quite well. So it wants to restart on me. Market to book ratio, again, market value divided by the book value. Again, if you can find an undervalued stock, that may be a good bargain relative to the rest of the market. Again, there's many more details, and unfortunately, the reason why the stock market is up right now is the rest of the economy is not exactly booming. But one visible thing the federal government does control, or indirectly through the Fed, is the stock market. So the stock market, I think everyone would agree, is artificially high, and it has nothing to do with the strength of the companies. In fact, some of the companies are quite weak, and so to dig down here into the fundamentals and the rest of the analysis, it's very hard to predict the stock's appreciation based upon fundamental analysis when there's so much external influence right now that's affecting stocks and stock prices. Anyway, fundamental analysis based on the assumption that a stock's intrinsic or real value is determined by the company's future earnings. So again, if you're going to be a fundamentalist, you look at the the strength of the company, the industry, where that industry is going to be continuing to grow, and then products and economic growth. That is one strategy to determine. Now, technical analysis, these folks, largely chartists. They look at patterns and charts, and they don't necessarily spend a lot of time with earnings. They don't spend a whole lot of time even looking at the company. They just do technical analysis, and they believe they can predict where the stock price is going to go. I'm not a big believer in strict absolute technical analysis because I would not want to blind myself to some of the more obvious, you know, relevant details that would occur in fundamental analysis. So perhaps a combination of the two. This efficient market theory, this is, again, where, um, stock price is purely random. So that's sort of the absence of a strategy. Again, it's not something that's in favor. Most people, I believe, would be weight their analysis probably 75% fundamental and 25% looking at the charts and the technical analysis. And I don't think efficient market theory really plays much of a role in most financial advisors' selection of stocks. Okay, so I talked a little about how stocks are sold. The primary market, you probably are not going to be buying stocks directly in the primary market. Um, you know, there's investment banks, there's institutions, there's people buying directly. But the secondary market is um, the market that most people will trade in. That's currently traded among investors through brokers. So, again, you've got the big full service sort of brokerages, and they also have, streamlined electronic trading type things. But, these would be like the Merrill Lynch type folks. And then the other brokers that are more in vogue and far less costly are the online brokerages like Scottrade, E-Trade, places like that. Charles Schwab. The actual places where they're traded, um, obviously it's sort of incidental where what market it's actually traded in. You're primarily looking at the company you're interested in trading. If it's a large company, it likely might be on the New York Stock Exchange. But for most of the companies that I typically trade with, they're a lot of times listed on the NASDAQ, which is just a smaller electronic exchange. Also, if you want to invest in foreign stocks, you can, but it might generate a lot more headaches and paperwork than it's worth to you. You could potentially, if you wanted to go foreign stocks, I've held foreign stocks before, but never directly. I was in mutual funds that had a international component to them. So all the paperwork, all the reporting details fell to the mutual fund company, and I could see what stocks I actually owned, but I was alleviated of all the nightmare of trying to keep up with all the foreign requirements. Each to his own. This where I talked about NASDAQ, that's actually how NASDAQ is spelled out. It's just pronounced NASDAQ. And when they say OTC, over-the-counter securities, um, electronic marketplace for 3,200 stocks. So anyway, a lot of times you'll see, high-tech kind of companies traded on the NASDAQ, and like I say, you're more interested in the company. It's not all that relevant which exchange it's actually traded on. Again, people, broadly well, there are pretty stiff requirements to be listed on the New York Stock Exchange in terms of capital and other requirements. So they are the larger companies. So I guess New York Stock Exchange is probably more prestigious, and NASDAQ is kind of the up and coming type stocks. Brokerage firms, yeah, if I want that sort of personal attention, I have had to reach out to a broker on a few occasions, even with E-Trade and Scottrade, and they do have people there who have the licensing and the rest of it. But for the most part, I just do it electronically, and I think that's how the majority of folks do it. But the problem is, and I'm not exactly sure, what folks' financial means are, but if you're the person who's got, say, under 100,000 bucks, these guys are not really going to be, you know, catering to you. You're going to be pretty small potatoes in their mind, and so yeah, maybe if we're millionaires, we might get better treatment from those folks, but for most of us, I wouldn't recommend going that route. The discount brokerage versus the full service brokerage. Again, if they were offering good advice, I might talk about paying for it, but I haven't found that to be the case. The fees, charges, commissions, it is competitive, and if you're using a discount brokerage, the onus is on you. You need to do the research, you need to do all that, but generally the tools are available, and you've got your own interest. You're probably the best person. You're the most focused on your own needs, so it's certainly not a bad way to go. And charges and commissions, I mean, literally, we're talking under $10 a lot of times for different trades, so not a big issue. And you can jump in and out of the market, and some people do. That'd be day trading. When you are buying a stock, you can say, the stock price is going to be jumping around a bit, and you can say, I just want to do it at market. Sell me the stock, at the going rate. There is some risk that the price might zoom up and you buy it at a little higher than you wanted to, but market order is going to be the quickest order. It's going to get done. You can also request to sell at a specific price, and I've used that sometimes where I want to lock in some money. Let's say I think the stock's going to trade up to $40, and if it gets there today, I'm going to put a limit order where I want to sell at 40, and that'll happen. If it doesn't get to that price, then it's not going to sell. A stop order, you can also try and lock in your profits. If you think it may get to 40, but you certainly want to lock in some profits. If it drops below 35, you want to get out. Well, that can be one way to lock in your profits. The bad thing about that, though, is it can be at 38 all day, and now all of a sudden it drops to 35, and you're locked out of the market. So maybe you should have just sold at 38. Anyway, different strategies. I tend not to like stop orders, though. If I'm nervous and I want to get out, I will generally just get out rather than be knocked out of the market by some momentary fluctuation where the price drops a little bit and then springs right back up. Long-term, short-term investment strategy. Yeah, so most folks, should be in a buy and hold mode. That's what you're hoping. You're hoping for stock appreciation, and you're going to sell when the price gets higher. Dollar cost averaging, what that would be is let's say market timing is kind of difficult, and what you're going to do is you're just going to put in $100 a month into a certain stock, maybe a larger amount every 6 months. Anyway, at some regular interval. And what this would do is, if the price does fluctuate, you would get in at an average cost. For getting involved in stocks, doing dollar cost averaging, I've never done that. I have done it with mutual funds, but usually stocks, it's more of a decisive move where you think the price is low and it's going to go up. I don't necessarily want to wait around 6 months. But again, the authors here have a sort of a preference towards larger companies, and so it might make more sense for the dollar cost averaging. The DRIPs, direct investment reinvestment plans. Generally, if you are going to be getting a dividend, you can either have that dividend awarded to you, given to you in cash, or you can just buy more stock with it. And so that's an alternative. Day trading, again, day trading is kind of beyond the scope of this. What day trading does is, the fact is most people lose money when they do day trading, but that's taking very short positions, jumping in and out of the market, and it's a lot of people think they're pretty good at it, but tell you what, most people lose money. But it's making money on just small fluctuations in stock, And if you are interested in, plenty of books out there on it, and there's plenty of places set up to help you do that, but I would not recommend it. Um, Buying a stock on margin, a little dangerous. What happens here is if the stock drops, you're actually financing your purchase, basically. So um, you buy stock on margin, so a lot of times it's a 2-for-1 rate, but you have to maintain that margin. So if the stock price starts to dip, you'd have to put out more margin, or your stock will be sold, locking in your loss. Not a good situation. Selling short, that is selling a stock. Well, they call it borrowing a stock. Basically, you're selling a stock thinking that the price is going to drop, and then you're going to eventually purchase that stock at a later date for a lower price. Problem is, if the price goes the wrong way, again, you're in trouble. Options, this is again a secondary market where you're trading based upon, you have the option to buy the stock at a different price. So you expect the price to go up or down, and you would buy the option to buy that stock at a discounted rate. Again, a little bit more advanced than typically what you'd have in your portfolio for a situation that you typically find yourself in terms of personal finance. All right, so that was the stock issues. Again, we'll talk a little bit more about stocks, but I think for most of us, we'll be primarily looking at mutual funds. Mutual funds, you're buying into the same equity market, but you're buying a variety of stocks, and you have, you know, lower fees and well, lower management fees in terms of what you'd be looking at if you had a collection of individual stocks on your own. Talk about bonds. Categorically, bonds are definitely out of favor at this juncture. The problem with bonds are interest rate dependent. As interest rates go up, the value of bonds goes down. Interest rates right now are at a very, very low level. So, and as we said, the stock market is doing quite well. So, to invest in bonds right now would be kind of strange, because when the market does eventually go down, interest rates are going to go up, and when the interest rates go up, bonds are going to become less valuable. So there's really no logical reason why somebody would take a large position in bonds at this particular time. Let's step through them, explain a little bit about bonds, and it'll make a bit more sense. Characteristics of corporate bonds. It's basically, pledge. They're trying to generate some income. They're selling bonds, and in this case, $1,000 bond with a maturity date. So what's going to happen at the maturity date? You would get that money back, that $1,000, and in the interim, you would also get the interest rate. Now, if you don't keep that bond to maturity and the interest rates go up, that bond is going to be worth much less. So if you will hold out to the maturity date, you will get your $1,000 back. But in the interim, say 5 years from now, and you're looking at a liquid investment, you're going to try and sell this thing. Odds are, with the market giving conditions right now, you're going to lose money. Normally get the payments every 6 months, and then the bond indenture, that explains a little bit about the situation. Now the company itself, you will buy, let's say, bonds in General Electric or something like that. You won't actually be dealing with GE. You would have a trustee, the independent firm that would take care of the transaction for you. Why do they do it? To get funds for major purchases, business activities, all the rest of that. Um, Interest paid to bondholders is tax deductible as a business expense for the company, so they're happy to do that. Debenture, um, unsecured, backed only by the reputation of the company. So again, not necessarily a secured mortgage bond, um, that is backed by the real estate. Although if it's a derivative or it's backed by worthless real estate, we all saw what happened there. So that's not a good situation. Better than debenture though. Subordinated debenture bond, again, a secondary claim to that. In a convertible bond, you can trade that out for common stock. High yield bond, again, what do we know about yield versus risk? A high yield bond, the pejorative term for this would be a junk bond. So higher rate of interest, but has a higher risk of default. So that's why it's paying the interest rate it does. The call feature, let's say interest rates go up, they can call the loans back in. Or actually interest rates go down typically would be when they would call them, because they would not have to pay as much interest. They could get money loaned to them, the corporation could, for a lesser rate. So they would probably be interested in doing that. Anyway, for the first 10 years, 5-10 years, you're typically safe, but most bonds are callable. Sinking fund, that's a way to, when they can pay off the bonds, and the serial bonds are single issue that mature on different dates. So it gives you a series of different closure dates on bonds. Why do investors purchase corporate bonds? Well, you get the interest, so you're going to have a steady income, and it's just a different type of investment. There's different characteristics with different bonds. You've got coupon bonds, bearer bonds, zero coupon bonds. Zero coupon bonds, for example, they're sold at a lesser rate, say like $700, and they'll mature at $1,000. They won't pay any dividend in the interim. Other coupon bonds, they do have actually a little coupon type thing attached, and that's how you receive your dividend payments. And then bearer bonds, these are kind of dangerous, because if you show up with a bond, it implies you have ownership, and you're paid. So those are the ones that you see in a lot of these spy movies or whatever, where they have bearer bonds that have basically been stolen. Typically a stock certificate is just a piece of paper, but a bearer bond is actually more. It has some intrinsic value. Dollar appreciation of bond. Well, this would be a good thing if somebody else at a higher price, if the interest rate on the bond is higher than the market value. Bonds right now are so cheap that when interest rates go up, it's going to be the other situation, where the bond value is going to be worth quite a bit less. So that is sort of a unique situation that we'll be in probably for the next 5-10 years. Mechanics of bond transaction. Bonds can be held until the maturity or sold in the secondary market, sold through full service brokerages, discount brokerages, or internet. Again, relatively small commission, and all of these interest and capital gains obviously are taxable. Now these are on corporate bonds. Municipal bonds typically are tax exempt. Federal and state and local governments, these would be the munis or the federal bonds. No state income tax on those. States, local municipalities. And then you have the government bonds like T-bills, T-notes. The difference between those are the time periods. T-bills generally up until a year, and then T-notes somewhat longer, 2 to 10 years. Treasury bonds, again, these ones are out to out to 30 years. Treasury protected, again, kind of a gimmick. They factor in inflation. Again, you know, not a real popular investment product at this juncture. The federal agency debt issues you can buy through, these are the big mortgage guarantors. So you got Fannie Mae, Freddie, and Ginnie Mae. Again, you know, it's the bond is only as good as the underlying security. Slightly higher than Treasury bills. You know, the Treasury securities are backed by the full faith and credit of the federal government. These ones are backed by the underlying mortgage. Munis, these ones are backed by the local governments. So two different kinds, general obligations, that's backed by the government, and the revenue ones are just backed by the projects. So again, just because it's a muni, you know, obviously the general obligation one is going to be more secure than the revenue. People like these because the tax exempt thing. I mean, there are some other things. They like to invest close to home and all that, but most of the time it has to do with the tax situation. Alaska taxes are not as significant, so not as much of a draw. That's how you calculate the yield. So again, we did this on the midterm, and you figure out what the equivalent rate is if it was in a tax situation. The sources, again, just the internet. Not a big fan of that. I prefer specific sites because, again, you find yourself kind of into the scams. But again, anything with a .com, not a big fan. I prefer to look at the objective rating sites. So again, you've got plenty of legitimate stock rating services and other rating services that will also do bonds, and they typically are not the .com type of folks. You can get the annual reports, and it would be a good thing because the value of your bond investment is backed up by the strength of that particular company. Bond ratings, again, so rather than the internet, you know, we've got Moody's, Standard & Poor's, Fitch, all these folks. And you've got, you know, AAA, which would be investment grade bonds, down to D. D, just think of that as default. They are in default at this point. Junk bonds would be in the C range, and they'd be a speculative type bond, not an investment grade bond. Bond calculations, so current yield, you get the annual income divided by the market value. And this is how you do the yield to maturity. So the annual interest, the face value minus the market value, number of periods, and then the market value plus face value divided by 2. That gives you the overall rate. Any questions on that? I kind of skipped through, not skipped, but we didn't spend as much time in bonds as typically would, but I don't see any time in the foreseeable future where bonds are going to come back to being a good investment. You know, like it or not, right now the stock market is raging. As long as they keep pumping money into it, it'll probably continue to go up. But when they start to taper, when the Fed starts to you know, reduce the amount of quantitative easing, the money they're pumping into the market, that market will probably flatten. But that doesn't mean bonds are going to be good, because what's going to happen is interest rates will go up, and bond prices will go down. So not a good place to be. Anyway, on a cheery note, sorry about that.